So Bruce graduated from Vanderbilt here as a mechanical engineer, and I've already talked to several people here who started out as engineers and then moved their way into finance. He worked for the IBM mainframe division, then attended Harvard Business School. At Harvard Business School, he played hooky on Fridays to go work with Summit right as they were starting up. And has had a very successful career there. Now chairman of Summit Partners. In addition, he's a member of the Vanderbilt Board of Trust. Until this June, he served as a director for the National Venture Capital Association, which is really sort of one of the premier organization private equity and venture capital groups in the country, as well as being chairman of its growth equity group. From 2006 to 2009, he was named to the Forbes Midas list, and given that time frame, that's a pretty important time to be recognized as sort of an outstanding investor. So, Bruce, thank you very much for joining us.
Thanks, everybody. So this is a practitioner's attempt to present in an academic manner. Although I didn't see any cartoons in anybody else's presentations, you're going to get a few. As Nick said, thank you, Nick. This is my background. I prepared this for. I spoke to the career planning group at Vanderbilt one time, and I did it like this. The kids seemed to like it, so I thought I'd show it to you guys. I'm from West Virginia, but as Nick said, I got here to Vanderbilt in the late '70s, early '80s, and had a terrific experience, and have spent a lot of time at Vanderbilt since. When I joined Summit in 1986 and skipped class on Fridays, I thought my professors wouldn't notice, and I learned that they did at the end of the semester. But I've been with Summit for 28 years. We started out as a late stage venture capital firm. We had about $160 million under management. I worked for the guys that founded the firm for about 13 years. And in 1999, myself and a couple of my partners co-led a leveraged buyout of the business. And we bought Summit from the founders. And it was an interesting thing to do in the construct of a venture capital growth equity firm at the time. But we've grown it since then. We've got 3 offices, about 160 employees across those offices. And we manage 3 businesses. We have a late-stage venture business, a growth equity business, which is a combination of dollars and euros. That's about a $4 billion business, $4 billion in capital under management, and then a credit business that does a couple of things. One is it co-invests with our equity businesses when we make leveraged buyout or leveraged investments, and then the other one. Another piece of it is precluded from working with our companies that we've made equity investments in. So we're pretty, kind of a multi-strategy firm would be the way to think about us. I just for fun decided I'd go to the New York Times website and look and see when I could, pick up references to venture capital and private equity. And the first venture capital reference I could find in the headlines, this was an admittedly unscientific search, was, I think this guy Schramm was a Treasury Secretary in 1944 who was saying that the country needed more venture capital. That was the first I could find. But there was, by the time you got to the end of the 70s, people were talking about both venture capital and the buyout business. And then in the 80s, we ended up with Barbarians at the Gate and the whole merger business and takeovers and hostile takeovers. But the naming conventions were relatively simple. And right around this time is when I joined Summit Partners. I joined in '86. The summer of '85, I had worked at Salomon Brothers in New York. Had a summer job there between my first and second year at business school. And I think that was the summer that Michael Lewis wrote Liar's Poker, and it was also an interesting time to be there. But it was pretty simple naming conventions. I called it private risk equity because I think there's some confusion about what you might call the overall industry, because sometimes you call the overall industry the same thing as you call half the industry. And I'm differentiating by just putting the word risk in the middle there. But then we had the internet boom, which was an interesting time to be in the business. It was particularly interesting in 2000, 2001 as it all crashed. And I found my first reference to private equity in the headlines of the New York Times in 1999, which it surprised me how late that was. And maybe there are references that predate that, but it was a late name change. And again, I would call it the private risk equity business, so as not to confuse things. But venture and private equity were the naming conventions that were used. And the reason that I think about it this way is that one of the problems we've always had relates to benchmarking. And how do you benchmark our strategy properly, which is more growth focused, but is sometimes benchmarked against the private equity business. I'll talk more about that in a bit, but the naming for me is important because of the way I think about the business. And then we had, of course, we still have, we've had cheap debt, and that's had a couple of cycles in the private equity business. But I think where we are now is we're in a place where institutional investors are starting to understand that there's segments and strategies within this industry, and that these segments and strategies bear some focus because they involve different activities with different types of companies that produce differential or differentiated return streams that are sourced from growth or from leverage or from a combination of the two. And I think in order to understand how a particular firm is doing, you need to understand their strategy and compare them against other firms of like strategy. And you know, what I'd like to do is I'd like to talk mostly about, if you go back, the venture capital side, which, if you think about this, this is an old analog radio dial. Everything, all these strategies sort of blend into each other on the edges, and if you go back the other way, they do the same thing. So somebody that does growth equity investing on the edges is going to be doing some buyout work. If you look at their portfolio, it'll be a mix of some things that you could construe as buyouts. It'll even be a mix of things that you could call late-stage venture opportunities. But the core of what it is it's investing in later stage growth, and it's making its money based on the growth characteristics of the businesses that it invests in, as opposed to the use of leverage. And the reason I want to pull that out is I want to think about from another angle what it is that venture capitalists do, and that is that they finance emerging growth companies. And they finance all stages of emerging growth companies. I mean, you got the angels that start, and then the early stage people, and then the core venture capitalists. You get the growth funds, and then finally a company gets big enough that it's not sold, it goes public. And so the part of the market that I'm concerned with and think a lot about is the venture part of the market. So enter Sarbanes-Oxley in the early 2000s. You know, it used to be in the 90s for my firm that our single biggest competitor was the public market. Companies would come to us and they would say, hey, geez, your valuation is nice, but I can get so much more from the public market, I'm just going to go straight public. And so there was a lot of choices that were made at that point in time about those types of those types of competitive competitions. And so anyhow, so Sarbanes-Oxley happens in the early 2000s, and immediately what you see, this is a lot of my assertions are unproven by the data. This one I feel better about the data. It's probably not solid enough to really prove it in an academic sense, but to me, when Sarbanes-Oxley happened, immediately you saw an effect in the IPO market. There were just fewer IPOs. It became an unpleasant experience for companies to go public. It became difficult and expensive, and it took capital out of the later stages of the emerging growth companies' financing continuum. They had to get, a lot of times companies had to get capital for the later stages of their growth and development. They used to count on the IPO market. IPO market went away. And so even yesterday, in yesterday's Wall Street Journal, companies still shunning IPOs, even you know in a market where Alibaba gets public. But if you look at the numbers are way down. And one of the things that this particular article says is that the numbers are way down because providers of growth capital have stepped in and do things now that the IPO market used to do in the 90s. And you can see that when you look at this data. This is from Cambridge Associates. They have a definition of venture capital, and they have a definition that they've recently developed of growth equity, and they look at commitments to funds over time from the early 2000s to now. And you can see that in the early 2000s that the venture capitalists raise more money, and Sarbanes-Oxley takes hold. The IPO market starts to shut down. Companies still need money nonetheless. Early stage investors need to get liquidity sometimes before they can get their companies public. They want to sell to other larger later stage firms. Those larger later stage firms are able to raise more capital, and you can see it with these numbers. The dark bar being the money that's committed to growth equity. It was smaller than venture in the early part of the 2000s, and now it's largely ahead on an annual basis in terms of new fund commitments. So, thinking about research topics, which is one of the things I'm trying to be helpful here, are things that maybe need some attention, and one would be growth equity, and I'll talk about why I think that. So going back to what we talked about, so growth equity is part of the venture capital. If you take a look at the radio dial, the strategies that all of us have, it's a core strategy, and it's also a key part of how emerging growth companies get financed. And what it is, it's these things. And we spent a lot of time thinking about what growth equity firms do. I think the key piece is that the companies are growing, and they're either profitable, cash flow positive, or they have a path to profitability. And a lot of times it's the original founder that's involved. Not every time, but it's companies are bootstrapped, and the investors that play in this market aren't really particularly control oriented. They're more convince and cajole as opposed to command and control. And I think about that as a key difference between the way a growth equity investor behaves and a buyout investor behaves. We work with entrepreneurs, and we don't tell them what to do. We try and back good people and then help them scale their companies. But the other key thing is that because we're investing in the later stages of the emerging growth markets, we have portfolios that look a lot like those of earlier stage venture investors. They don't look exactly alike. There's probably some embedded leverage in the portfolios. There's some industry mixes that take us beyond technology, because you can find growth outside of technology. There's probably a geographical mix that's broader, which I think has public policy implications. And we've looked at our portfolio, our growth portfolio, and we've seen that it's not as concentrated around our coastal offices as our venture portfolio might be. And then the investments, I think a couple of the keys when you're involved in the later stages of emerging growth company financing, you have to do a couple of things. One, companies need capital because they need to fund their growth. They need to make an acquisition, and you provide capital for conventional reasons. The other piece is that companies have gotten to size. Entrepreneurs feel like, wow, I have this thing that has value. Maybe I'm over allocated to this particular asset. Maybe I should do some things to diversify, and they'll sell some stock, and you have to be comfortable buying from somebody you're then going to rely on to continue to run the business. And then earlier stage investors have a fund that has a life that's defined, and they get towards the end of that, and they may need to sell too. So a big piece of what we do is we buy stock from selling shareholders in addition to providing capital for companies. I say just as often with money that we invest goes into somebody's pocket as it does goes into the company. The other thing is that if you look at a portfolio of a growth investor, it's our portfolio, for example, is 65% unlevered. and the other 35% is levered, and I think the average leverage across the whole portfolio is I don't know, 1.9 times EBITDA, and you can, I don't know if it's current or forward year, but it's relatively light leverage in the grand scheme of things. But that also means that it's 1.9 across the whole portfolio, and it's 2/3 unlevered. That means you have some leverage buyouts in there too. We have some things that are levered 5 or 6 times, and so the thing that a growth firm has to do is it has to build skills that involve the capital markets and involve debt. Like we have a capital markets group, and all they do is they help our companies raise debt and equity. And you have to develop skills that take you across the border lines of the various investment strategies in order to properly do the kinds of things that we do. The other key thing is that often when we get involved, again, if you look at that emerging growth company financing continuum, we're kind of last before a public offering or a sale happens. Yet we have to make a return that's good enough for somebody to want to give us some money the next time we go out to raise capital. And the way we do it is we try to identify growth, and we try to help companies scale, and we don't worry too much about how long that takes. But we can't typically pay it. We can't typically do a dividend recap along the way because our companies are growing so fast you can't lever them, or they don't want to be levered, and you don't control them, and so it's a mix of activities that sits somewhere in between what people in just the core part of the venture market do and what people in the buyout business do. And this is just kind of another way to think about the kinds of things that we do, and it contrasts the various strategies. I would say, even though I have it split into 3, because of the fact that venture and growth equity investors are focused on financing for emerging growth companies, I'd group those together fundamentally and contrast the strategies of those two with what happens in the buyout business. Cambridge Associates recently decided that it was a category. They call it an asset class. I would probably call it a sub-asset class or an investment strategy, but nonetheless, they say it's a distinct way of thinking about how you finance private businesses. And then the other thing that they did is they looked at returns to venture, buyout, and growth equity, and what they found was that the returns to growth equity and buyout were largely the same over these periods of time. I think these time periods are a little bit affected to the benefit of buyouts because we've been through such a favorable capital markets period, except for that little slice in 2008 and 2009. And I think it's benefited buyouts. In my experience, what usually happens is that our returns is that buyouts and ventures swing around a lot, with buyouts being very dependent upon the stock market, and venture being very dependent upon technology cycles and perhaps the IPO market, and we kind of float around with a little bit less volatility in between the two. I can't prove that. That's just what I think happens. The other thing that happens in growth investing is that the loss ratios are lower, and they're lower for a specific reason, and that is that we're investing in companies that have scale and have size, so there's some protection in that. We typically take minority positions, but we have a senior security, and when we invest, it's unlevered. And so if things go wrong, we don't get wiped out by the leverage that sits on top of our position. And because we only own a minority share, what's under us for the most part is common equity. It gets squished in value, and our liquidation preference protects us. And so I look at the strategy and think this is sort of like investing, where you have an effective put option that protects you at a fixed price. And so on the downside, you've got a stop loss that sits there on the one hand, and on the other hand, you're investing in a company that, because it's a venture-like business, has the potential for runaway runaway upside. We made an investment, for example, in a business in 1997 called E-Tech Dynamics, and they made a device called a dense wavelength division multiplexer. And what it does is it creates light circuits over a fiber optic line. It used to be that all the light circuits were white, and then somebody came up with the idea, oh, let's send a purple one and a red one and a blue one and a green one across, and we can increase the capacity of all the fiber that's been laid. And so we invested in that thing, and it grew. We put $100 million in it in 1997, and at a $200 million valuation, and it grew from $70 million in revenues in 97 to $1 billion run rate in 2000, and we sold it for $19 billion and made a $4 billion gain. And that's the kind of thing that you can do with our strategy. You don't do it as often as what happens with the earlier stage strategies, but yes.
I'm trying to figure out where publicly traded shares come in. Does growth equity, the term, include publicly traded shares in your portfolio? Or are they all closely?
We invest in. Yeah, it's a good point. We invest in private companies. We haven't invested in a public company since 1989. I think for the most part.
Does somebody sell you shares, for example, that might be publicly traded? Would you turn them private, so to speak?
No, we're investing in private companies pre their public offering, and that's typical of it. When I say we, that's what we do, but that's typical of the strategy. Occasionally there'll be opportunities, and some growth equity firms that have crossover strategies will do this. There'll be opportunities to buy blocks in public companies, either at a discount because somebody wants to sell, and that's the person that wants to sell is somehow restricted, or in a better security, a senior security, maybe at a premium, but more likely close to the par price. That's an edge business. The core business for this type of investing is, again, it's an extension of venture capital, which implies that it's private company investment. So, just thinking about regulation, which is, I think, another topic that I know the academic community takes up from time to time, and I'm sure that people have looked at the Sarbanes-Oxley regulation. One of the things that happened that came out of the financial crisis, of course, was Dodd-Frank, and one of the things embedded in Dodd-Frank directed the SEC to define venture capital. And they came up with a bunch of rules about venture capital, and rather than run you through the rules, I drew a picture. Basically, what the SEC did is it derived some rules. It took a big old chopper and chopped the industry in half, and they just kind of sliced it. And if you were a venture capitalist, you were excused from having to register as investment advisors, and if you were deemed to be not a venture capitalist by this definition, you had to register. And with registration comes lots of compliance rules and some expenses, and the SEC shows up on your doorstep and audits you, and does a number of things that serve. One of the things that I'll just say as an aside, one of the reasons we had to register is because we manage fixed income funds, and if you are an advisor to funds that don't include venture capital funds, then you have to register for that reason too. The logic of that I'm not exactly sure of, but that's what happened, and so right as these dollars started to flow into the private alternative to the public markets, the SEC said, let's regulate that thing. And my fear, just as a practitioner, is that it'll create in the same way that this is not a scientific chart. It will create in the same way that Sarbanes-Oxley created a vacuum of in capital flows from the public markets, that it will do the same thing with the later stages of the private market alternative to the IPO market. And basically, when I look at it, just thinking about it, Sarbanes-Oxley pulls the green line up because companies have to be more mature and they have to be larger in order to get public. And the Dodd-Frank rule pushes the red line down. And the reason it pushes the red line down is if you're in the venture capital business and if you're not regulated, you don't want to raise a fund that would take you into the later stages of investing for fear of running afoul and having to register. And it's, you know, and it's just an unpleasant thing that you'd rather not do. So it's going to take some fraction of the people and keep them out of the market. If you're in the growth equity business, a percentage of people that we compete with don't have to register, and the reason they don't have to register is because they don't run afoul of some of the detailed rules. But what they do have to do is they have to manage their businesses and the investments they make in a way that they stay on the right side of the line. Because if you ever cross over to the wrong side of the line, you never get back. It's just, you're stuck, and you have to register.
Cross over to the dark side.
Yeah, the SEC never lets you back. And so, to me, one of the questions, it's, you know, from an academic study point of view, is what is the effect of the Dodd-Frank definition of SEC on the overall emerging growth financing continuum? That's number one. And number two, where is the right place to draw the line? And where does venture capital end, and where does something else begin? And to me, the best way to organize it is around the emerging growth company. And I know the buyout firms don't invest in emerging growth companies; they invest in other strategies that are interesting and may produce better performance over time for the types of things that they do. But that's the way I think about it. And so when I was on the board of the National Venture Capital Association when this particular thing happened, when the rule came down, and I, to be honest with you, was disappointed with the public policy result. And so I went to the guy that was the chairman of the board and the president of the National Venture Capital Association. I said, look, I don't know whether I should stomp off Matt or try to change things. And because it wasn't clear to me that Summit Partners should be part of the National Venture Capital Association anymore because of the way that it was the SEC defined the work that we do. And so we all decided, myself and the folks I was talking to, that it would make sense to form a growth equity group that would focus on public policy issues for that part of the venture, that type of venture strategy, that part of the financing cycle. And we formed this little group, got it formed in 2013. One of the first positive things that happened as a result of that, in our opinion, was that Cambridge Associates saw what we were doing and talked to us and came out with their report on growth equity. And we sort of more or less formed around public policy objectives. And one of the things that we concluded, it was myself and 4 or 5 other board members, and we gathered about 80 firms who paid a little bit of attention to what we're doing, but not a lot, because they're all trying to make investments and don't have time to worry about public policy matters. But we decided we would do our own academic study, and we did it in a way that I think would be considered very light by this group. But what we wanted to do was just think about, we always thought that our strategy was goodness and light and motherhood and apple pie, because we were backing emerging growth companies, and when they grow, they hire people and create jobs, and shouldn't everybody admire that piece? And so we wanted to try and do some things to prove it out. And what we found, I'll just tell you up front, is that it's a really hard thing to do, to prove things in a way that they would stand up to scrutiny, and that the data that you collect wouldn't be subject to attack. And so one of the reasons I'm telling this group about that is my hope is that you'll hear what we tried to do and think that was pretty weak, but we could do a better job. And so we had a study. We said, okay, let's try and identify growth equity deals that occurred over the last 14 years let's try and find out how big those companies were at the time the growth equity investment happened, and then let's see how big they were when the growth equity investors were all done with them. And that was just the simple thing that we were trying to do. And 4 or 5 firms paid for the study, and we didn't pay for it. We didn't pay for it because we were trying to influence the outcome. We paid for it because nobody else would. And we used publicly available data. And the hardest thing that we encountered was just how do you define what a growth equity deal is? And we decided one way to do that was just to do it around the firms that were known to have a growth equity investing strategy. And we just said, okay, that's what these people do. Let's take their portfolios. Let's look at those portfolios, analyze them, and see what we come up with. And we had 65 firms. It's the interesting thing about the growth equity firms that are members of the National Venture Capital Association. I think there are 450 firms that are members of the National Venture Capital Association. So all U.S. firms. There's probably 80 that are members of the growth equity group, but they tend to be much larger on average than your typical venture capital firm would be, and they would, because of that, they would tend to they would tend to pay more of the fees for the National Venture Capital Association than you would expect to be a more important part of the business than their numbers would imply. And so anyhow, so we did this, and we had sort of an anomaly in 2000 where there was a lot of activity, but it was a pretty steady number of deals across a period of time. And there was a lot of tech that was in there, and a fair number of the companies were still active when we ended the study. And those are just some numbers about the number of investments. So it was it was a lot of investments, a lot of numbers. We did some analysis on it, and the short story, and we didn't have a lot more conclusions than this. We were just trying to see, was there some reasonably positive correlation between what we do and the growth in employment across the period of time in our involvement, as a way to again prove our goodness to the public policy people. And so that was the answer. And I think what's happened in that part of the market is there's been a fair amount of activity, but I think it's been understudied by the academic community. It's probably not well understood by public policy makers. I think institutional investors are starting to better understand the strategy and know how to compare it between, slice and dice it so that they don't directly overlay it with buyouts and venture. But one of the ways that I think the academic community could get involved would be to start to look at the different segments in maybe finer detail and think about strategies and think about what those strategies produce, and help the public policy people understand just exactly what it is that we're doing, so that they can make better decisions. And I know it's time for me to finish up here, but I was thinking about other ideas and things that I've encountered that might make worthwhile study topics. I mean, one thing is the corporate structure. This is Summit Partners' corporate structure. In fact, this is a couple of years old. It's even worse now. And we're trying to think about how do we actually create a corporate structure that is simple enough that as our business grows, that we can aggregate equity value in a place where eventually it could be gathered, and further, how do we stop the mentality that many in our industry have, which is you have a management company, the management company produces profits, the profits need to be distributed at the end of every year, and there's no collection of retained earnings as a way to build a business inside the investment management business that you've got going. And so that's a thing that we think about. We're actually working on real time. Another thing is succession. So when we did our leveraged buyout in 1999, it took us 2.5 years to negotiate it, and it just wasn't an easy thing to do. And now here I am, much older and later on in my career, and now we're starting to think about how do we do the same thing with the next generation. There's just not a clean way to do that, and I don't know if anybody's, I'm sure there's been studies of succession in the industry, but it's a difficult thing that probably deserves some attention. The next thing, the international expansion, we looked at opening an office in India. We opened it for a while. We didn't like the environment there. We shut it down. We considered opening an office in China. We didn't like the environment there. We never opened it. And for me, the question was always, what can we do from a U.S. point of view, if you're a U.S. investor, is what can we do to get our government to know that the deck is stacked against foreign investors when you try to go into some other locales, and does our government understand that? Maybe they do, I don't know, but I know when you go to some other countries to try to invest, you find that you're disadvantaged for lots of reasons relative to the local investors. The other things that we bump into in terms of academic requests for our time are deep dives into a deal or deep dives into a situation, so that you can create a story and tell that story to students in a way that there's some learnings from it, and those are things that I think are interesting. And then there's just these anecdotes that I heard along the way as I was in my career that stuck with me, and those anecdotes are all around points that are key functional things that happen in our industry, and I'm sure that somewhere in there are questions that you could study and do something with. And this is where we are now in the industry, and so I think that the final thing is, where do we go from here? And all this money's flowed in, all the excess returns been competed away. Is it really a good place to be as an investor? Is it a good place to be if you're a pension fund? And those are the kinds of things that I thought you guys might look into too.
Just give Nick the data and he'll figure it out.
That's all I've got. Thanks.
Thank
everybody.
you.
Are there any questions?
Yeah, just a clarifying question. So, you said growth equity is sort of new category. Is this same as the mezzanine financing that you had before? What led to the growth of the?
Usually people, when they think about mezzanine financing, they think about mezzanine debt, and it has connotations that relate to the the debt capital markets, junk debt.
So you said to take senior debt. What is your senior security? What is the security usually?
Preferred stock, convertible preferred stock. So we'll buy typically a convertible preferred stock. It may have some features, and it sits there senior to the common. It's always junior to debt, but usually when the companies are unlevered, you don't care about that.
And it will be senior to the earlier venture capitalists had?
Maybe not. That's a negotiation. In a market like the market that we're in today, if it's a tech investment in Silicon Valley, you're going to be pari passu with the earlier investors. And in more difficult markets, and particularly those that are away from the coasts, you're more able to negotiate. Seniority.
So how often do you sell? Do you exit through other growth equity firms, funds, or maybe even buyout funds? So I wonder how is it an increasing chunk of the companies that will always stay private? No matter.
It happens increasingly often, and it used to be we could make our entire business by being the first professional investor involved, and then selling to the public markets or selling to an acquirer. And really three things have happened. Thing number one is the public markets demand companies that are bigger and more valuable at the time they go public. The second thing that's happened is that the acquirers, particularly in the tech markets, have consolidated, so there are many fewer of them. And the third thing that's happened is there's money that's flooded into all strategies. And even and the buyout firms are all looking for things to invest in, and even our late growth things look attractive to the buyout firms, and they might be mature enough that they're leverageable. And so the financial investors are an alternative to a skinny down set of other liquidity options. And I look at it and say, okay, if you think about that part of the market as as the private alternative to the public markets, that's okay, because if you invest in a public company stock, every share of stock's, going to somebody, you're selling from one person to another, and it's sort of a similar thing except in an institutional sense.
Once a portfolio company IPOs, how long do you typically stay involved and hold your stock or be on the board?
It varies, depends on how much you own. The way and it also varies on the firm. We have a rule that our investors set up that 2 years after the last liquidity, which if you go public, it's generally 2 to 4 years before you can get liquid, and then 2 years after that, they refuse to indemnify you anymore. So there are incentives to get off the boards. That's the way our deal with our investors works. But yeah, I would say post public offering, it's somewhere between 2 to 5 years typically that you would be involved with a company post public offering in our strategy.
Apart from the operation improvement, you guys might sometimes advise the company to be more tax efficient.
Yeah, we work on that. That's not a huge thing for what we do. Ours is more about how do you scale, how do you put the right people in place, do you apply the capital markets in the correct way, do you and then maybe some micro things that relate to sales operations or supply chain and things like that. And we do that from the board. And then there's just the sounding board piece where you're on a board and you give the CEO some advice and maybe he takes it or she takes it.